afternoon. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another Barometer Readings webcast. Joining me today is David Burrows, our Chief Investment Officer, and as well, we've invited James Callahan this evening to talk about the markets. It was a really tough day in the markets, but I'm sure Dave will provide lots of thoughtful explanation and walk you through what Barometer has managed to navigate today and will do so going forward. As always, we invite questions, so don't be shy. You can email me at phastings@barometercapital.ca or hit us up on the Q&A or the chat via Zoom. And on that note, David, lots of questions, I'm sure, today, and I turn the conversation over to you.
Great. Thanks, Pamela.
Of course.
Thanks, James, for joining today. We appreciate that. Certainly, let's see if I can get my screen up here. There we go. So I want to thank everybody for joining us today. A sloppy day in the market. I mean, we've been basically up on a rope over the last little while. Lots of good things been going on in the market, and today's CPI number brought out some sellers. So one of the things I always like to say is a bull market is a slow grinding advance marked by short, sharp corrections. They come when you don't expect them. But my guess is there's a fair bit of buying underneath the surface, and we probably see it step in over the next few days. But we'll talk a little bit more about that sort of big picture. Just to start from the top, as we always do, we do believe that we're in a structural bull market in stocks. It started in 2013, the end of 2012. And while there certainly are, significant corrections along the way, it's like 3 steps forward, 1 step back. And when we look at the more near-term picture, that has been the case. Now, this is a chart from my friend Chris Cavacchio at Cavacchio Capital Management. He takes a look at something called the commodity channel indicator. And it's a very long-term indicator and highlights some of the difference between structural bull markets and bear markets. And I thought it was an interesting illustration. I thought I'd bring it up. In the bear market that went on from 1929 to 1950, 2 very significant pullbacks. And you can see on this CCI oscillator, 2 significant oversold levels. And these were very significant bear markets. These are the ones we absolutely have to avoid. But then once the market got going in 1950, over the next number of years, a series of pullbacks, but pretty shallow, staying above kind of the zero line, which ultimately marked secular bull market. Now, we looked at it very often as staying above the rising 200-week moving average. But you can see then after the late 1960s, a significant sell-off into 1971, a second significant sell-off, 73, 74. Again, this is a structural bear market where the market made no progress for an extended period of time. It ultimately breaks out, and through the 80s and 90s, again, had pullbacks. You can see it stays above the zero line. Now, from 2000 through 2013, we'll remember these periods because they're in all of our own collective memories. The tech sell-off, the tech sell-off and the financial crisis. Again, 2 very important sell-offs to have played defense through. And then, of course, we exited that period. We made new highs in the S&P, and again, we've had pullbacks, and they've been painful at the time. But when you reversed back up through that zero line, it tended to mean you had kind of like 3 steps forward. If you look at the very significant turning points since the 1950s, when you got up through that zero line and closed on a quarterly basis above it, when you were in a structural bull market, look out 1 year, 3 years, 6 years, 8 years, 10 years, very significant positive returns. We spent a lot of time talking to clients recently about the fact that when you exit a cyclical bear market, you certainly are going to have pullbacks, but the payoff is in being invested in important structural themes over the next period of time. So average returns going forward 1 year, 3 years, 6 years, 8 years, and 10 years. Now we want to see and make sure that we have a quarterly close above that zero line, which at this point certainly looks like it's going to. But when you went 1 year out, very small drawdowns. So, when we look at the picture that we've been looking at over the last, number of years as we've been doing this webcast now, I guess since the beginning of COVID, when markets stayed above that rising 200 week and eventually made a new high, you got pretty substantial run-ups in price. And here we are now, just 2 months having made new highs. This is from this morning. You notice that we cannot see any significant pullback than what we saw today, but it's in here. It's just, markets have been working their way higher. There's the daily chart of the S&P. We made a new high at the beginning of 2024. We had a sharp pullback about 2 weeks in. We had a sharp pullback today. These are pretty normal. If you put it in context and look at a weekly chart, these are all weekly bars, including to the worst point today. We're above the lowest point from last week, which was above the lowest point from the week before, which was above the lowest point from the week before. Let's make sure we keep these things in context. Now, that doesn't mean that things can't change. It wouldn't be completely unusual to see it pull back and retest this breakout point, which is not a long way from here, but we'll see. My guess is that there's a lot of people with dry powder. There's cash on the sidelines in private investors' hands. There's a lot of money in the hands of risk parity traders and volatility traders that have an ability to add a fair bit more. No trends are broken here. My guess is that some of the stranded money on the sidelines likely comes in as buyers over the next bit, but we'll see. If we look at the equally weighted S&P, we talked last week about the fact that we got up and through these highs from February of last year and July of last year, and we've been consolidating. In fact, yesterday traded up and above the range, but back into it today, basically in this area of congestion, working off the overbought condition you can see here on this relative strength indicator, got up into overbought territory in the middle of December, and now back into the middle of the range. TSX composite is very similar. We broke out, maybe we're pulling back and testing the top end of this range. Again, was overbought, working off some of that overbought. We'll take a look at what the market internals look like. The TSX, though, maintaining above this breakout point that we had recently, and we'll see where this month finishes. If we look at markets outside the US, I want to continue to hammer home the fact that after many, many years of underperformance, global markets look interesting. The Nikkei, going back to 1991, broke out over the last year. This includes a little bit of pullback today, but obviously looking very bullish. Looks like it's in a new bull market. India, same thing, pulled back a little bit today, but when we look at it versus the previous number of months, this is not a big deal. Mexico, broken out of a multi-year sideways period. And we've talked about Europe, including today. This is kind of the pullback that we've seen, not very much. So I think it's always important to pull the lens back. Nothing is going to go straight higher day by day. When we get strong performance, there's going to be a few days of sloppiness. We'll watch our internal indicators to see how they handle it. We know that global stocks relative to US stocks are relatively less expensive. Part of that is that tech makes up such a big weight in the US markets. Tech is behaving exceedingly well and probably deserves a much higher multiple than some other sectors. Very predictable companies that have shown long-term secular growth. But it doesn't mean there isn't an opportunity when the discount is significant. One market that we have not embraced is the Chinese market. You can see relative strength has been steadily weakening. It bounced a little over the last week. We'll see if they can turn it into something. There was some small improvement in the breadth model for China, but there's a lot of things going against that market. On the fixed income front, generational low in yields in 2020 and a sharp run up. not a friendly environment for bonds. To look at it another way, this is 10-year yields from 1981 through 2020, where they started to rise. And you can see every once in a while we've had a pullback where yields pulled back and bonds had a bounce, but then they went higher, pulled back, went higher, pulled back. We'll see, but quite a significant bump up in yields today. And if you put it in context to price, this is an ETF, the AGG, which represents the aggregate bond index in the US. It is a series of different maturity bonds from various quality issuers. And you can see that the AGG ETF made a high in the summer of 2020, a lower high in September of 2021, a lower high in June of 2022, a lower high in the early part of 2023, and once again, a lower high here coming into 2024. This is still a downtrend. Bonds continue to be in a bear market. I know people get excited when they see yields a little bit higher, but that being said, moving averages continue to move lower. Relative performance versus stocks continues to be difficult. If we look at how stocks have done since the bottom in rates, they've done what they're supposed to do. Stocks are a way to fight inflation. Bonds are not. So from the bottom in rates, sharp run up in stocks versus bonds, we went through the corrective period in 2022. And in 2023, that upward movement, stocks versus bonds, continued, and it continues to today. So we continue to like stocks over bonds. From the commodities asset class, the USCI US Commodities Index reversed higher in 2020. It's been certainly held up through the Fed's tightening cycle. We had a move higher in the spring of 2023, and we've been kind of chopping sideways on a relative basis versus the S&P, kind of hanging in there. We'd like to see it kind of get going. Last month, the month of the month of January, came out of the range. You can see that we've just sort of consolidated sideways over the course of this last month. We'll see where we go from here. Wanted to touch on real estate. People have talked about real estate, maybe, hoping for lower rates is going to be positive for real estate. I'm just running a simple comparison. This is the real estate development group of stocks. This is relative performance versus the S&P. You can see that really since rates started to rise, they've relatively underperformed. This index down 29% over the last 555 days. And if we look at the universe of REITs, real estate investment trusts, so trusts owning packages of real estate, since April of 2021, relative strength has been falling, and this index is down 28% over the last 549 days. No relative improvement in the performance versus stocks. So again, commodities and stocks probably our favorite places, things that we want to avoid, longer term fixed income, real estate, and things that act like bonds. So start the year, things have gone pretty well. Equal weight S&P to the end of the day yesterday up 1.4%, TSX up 0.77, the aggregate bond index down 1.3%. Our income strategy, which is largely dividend growth focused, up 4%, and the equity strategy up about 6%. Let's just talk about some key factors that we've seen over the last few weeks. We're, of course, still in the middle of earnings season. We've been chronicling this each week. Again, earnings and revenues are coming in pretty well. 335 out of 500 companies have reported. The average companies had revenue growth of 3.8%, sales growth of 5%. But what's probably more important is that there has been a revenue surprise in general of about 1% and an earnings surprise of close to 7.5% over the estimates. That means that companies have been productive in managing their costs because sales are up, but earnings up much more. Margins continue to hang in there. So earnings in general, pretty good. The current consensus for fourth quarter earnings is 15% earnings growth. So it looks like earnings growth bottomed in the fourth quarter of 2022, over a year ago, and earnings have been improving since then. Let's talk a little bit about CPI. CPI today is what kind of spooked the market. Of course, we're all looking forward to the point where the Fed decides it's time to cut. They have intimated that they are done with raising rates, but they are data dependent. If we look at the components of the CPI, this yellow bar is the services component, and the services component is largely made up of rents. So you can see that what came in a little bit hot was rents. Goods actually have been coming slightly down in price. So that's the purple. So the contribution has been low, and of course, energy has helped take some steam out of things. But the rents are the thing that we're going to have to watch. So we'll see how the market absorbs all this. Now, at the end of the day, we don't have to be everywhere. We have to pick our spots. We're hired by people to take their portfolio, make the best decisions that we can make, tactically invest in parts of the market that we think have a structural tailwind. So we call that market leadership. It could be sectors or themes or asset classes. Our job is to target productive assets. We're always watching for change, so we do these webcasts weekly just to examine our current position, to say, is there something we should be doing differently? And in the event that our work shows us that there is significant deterioration in the market internals, which we always talk about, we're certainly willing to play defense. At this time, the market internals are pretty constructive. So just quickly, the strategy that we follow, we believe 70% of return comes at the hands of being in the right neighborhood, the right asset classes, like equities, for instance, and sectors. And then we try to identify in our bottom-up work specific securities that are just doing better than the rest of their peers, fundamentally and from a price perspective, where we think the market should be prepared to and is apparently willing to pay a higher and higher multiple of earnings. You get rising earnings and a rising multiple, that helps you to make, much better returns. Now, this is a living, breathing universe. Our portfolios need to change over time, and we use a very disciplined selling process. We use stop losses on our individual positions to make sure that, little mistakes don't turn into big ones. So on days like today, we're certainly watching those. But given the fact that stocks have been working their way higher and our positions have been very, very resilient along the way, they aren't 1 or 2% below the surface. They're where trend changes, and we want to stay invested should they continue to stay in trend. The top-down work is all about finding parts of the market where over time a higher and higher percent of securities are performing well. In a healthy market, more and more stocks should be participating. When over time, fewer and fewer companies are holding up, meaning the leading leaders are strong, but the weaklings are peeling away, it means, first of all, we should tighten up our stop losses. Second, we should stop putting on any new positions. And third, we should be making sure that we've got cash in our hands that we could use to put to work when we see things change. So let's look at what's going on. As of today, you can see that all of the short-term indicators are positive. Now, we'll take a look tomorrow morning to see what changes, but I put these up for a reason. Markets tend to absorb news based on the underlying condition of the market. If there are shock absorbers built in, meaning the short-term indicators are positive, generally, pullbacks are more shallow. If you come into an event with a more constructive market, generally, sell-offs are short and sharp, but over quickly. We come into today with our long-term models for the local Canadian market positive, percent of stocks in uptrends, and global breadth has been expanding. We've talked a lot about that. NYSE, or the percent of stocks in uptrends, has backed off about 6% off the highs. But this week, the percent of stock trading above the 50-day moving average turned higher. The percent of stocks trading above their 150-day moving average turned higher. And the percent of stocks with positive weekly price momentum turned higher. So internally, things were broadening. Now, today, everything pulled back. When I looked at it midday, when levels were not far from where we are here, the percent of stocks that have given sell signals. In all of the NYSE, about 100 companies had given sell signals, and about 30 companies had given buy signals. Not a significant change. So I wouldn't expect to see significant changes in these indicators. Let's look at some of the charts to see what looked like at the group level. I'm going to start with technology. This is the XLK ETF, made up of the top and most significant technology companies. Relative strength has been rising since the beginning of January. This was a 36% decline going into October, and at the end of December last year, down about 33%. Relative strength started to improve. We started putting positions on in February and March in technology, and relative strength has been strong ever since, trading better than 86% of the companies in the S&P, and that includes, being down today. Now, when we look at the package of our companies, the companies that Barometer owns in the tech space, I asked James Callahan, who's on the call today, to talk a little bit about industrials, to put an index together of our holdings and how they're doing on a year-to-date basis versus that XLK. And I was pleased to see total return from our tech weighting, about 12%, versus the return from the XLK, about 4.9. Obviously, the package is doing pretty well. Moving on, financials. Rising relative strength since June of last year. The financial sector's had a great move. And we talked last week about the fact that virtually 100% of financials in the US are in an uptrend. What does that mean? It means the market can absorb some pullback and likely handle it without seeing significant breakage in trends. So we'll watch for that. But when we look at the monthly chart, again, this pullback here, just a fraction of what the market gained last month or the month before or the month before. This is not something for us to be concerned about, especially given that some of the oscillators are just turning higher for the sector. Now, we've talked a lot about the fact that our holdings are largely insurance and some large banks. There are some concerns about regional banks. This is the regional bank ETF KRE. It's been in decline since 2022. There have been some brief bouts of strength, but again, recently pulled back. One of the concerns in this area, and we've had clients ask about it, is commercial real estate. In some of the regional banks in the US, commercial real estate makes up between 50 and 70% of their loans outstanding. So that's an issue. So let's just take a quick look at our Canadian banks and see how much exposure. It's a very, very different picture. Percent of loans outstanding for the Canadian commercial banks, BMO's 10%, CIBC's 12%, Scotia's 9%, RBC's 10%, TD's 10%, National Bank Financial's 8%. They have loan loss reserves in their book for up to 2% of that. When we look at the impact on book value, this would be relatively small. So at this point, we're not overly concerned about commercial real estate in the Canadian banks, but certainly it's something that we look through as a lens when we look at our bank exposure. Our big weighting in the US, JP Morgan, they got the safest balance sheet we also own Citigroup, which also has a very strong balance sheet. So moving on to industrials, and I asked James to join us today. This is the industrial sector ETF, VIS. It's an equally weighted basket of industrial companies. I've highlighted here the period of the bear market. So starting at the end of 2022, the decline to the lows in June. Interesting, the market made a lower low in October, but the industrials held those lows. And we've seen a series of higher lows since then until ultimately we broke out of that range, actually back in November, well before the market made a new high. We pulled back and tested the upside, and here we are with a little bit of a pullback over the course of the last week. But again, we're still higher than the low point of the week before. Now, we have quite a diverse set of holdings, and I've talked about a number of them along the way. I asked James to jump on, maybe just to talk a little bit about it. It's an important group. It's just recently made new relative highs versus the S&P 500. And this is a group that has very strong balance sheets, very little debt, and the order books are pretty full. part of it because we've seen some improvement in the global manufacturing PMIs. We talked about that last week. But James, maybe you could walk through a couple of our significant names. We've talked a little bit about Howmet before, but maybe give a little background and some of your thoughts.
Yeah, thanks, Dave. I'm happy to. To spend time on the industrial space is always fun because they have such diverse business models inside. It's always, from a stock picking perspective, is always fun to talk about. So Howmet specifically, we've owned it since last February. We've really not done much selling, and it's been a core holding for about a year now. So they make airplane parts, specifically turbine blades and engine components. They also make forged wheels, but that's a smaller part of the business. And then they sell the components to defense companies for use in military aircraft and also into commercial plane manufacturers. So the company came out of an investment cycle in 2020, and this investment cycle began in 2018. So you can imagine what it was like to sell parts into the aircraft industry during 2020. They weathered that storm and had put themselves in position to sell higher tech components at a bigger scale than they previously were able to. And the stock's largely worked since then. So they produce in the US, they sell primarily into the US. So they're a beneficiary of the reshoring trade, which has been a good theme in the industrial space. And we're at the point where global airlines are back in a healthier spot. They've placed big orders, and Howmet stock is working on the back of this ramping commercial airplane production. So
So James, obviously a great day today. This 5% move off the, I guess, off the earnings. Talk a little bit about that.
Yeah, so they reported earnings this morning, and it was a pretty solid report. You can see from the chart, the last big gap was also an earnings report in, it looks like October and November. So the stock reacts well to an earnings report. Management is traditionally pretty conservative, but the story just continues. So management guided to $7 billion in revenue for 2024, which was a bit above expectations. Still is pretty conservative, which is good. It leaves room for further beats over expectations in quarters to come. So a lot to like. Yeah, to close up about 5% in a down tape like we had today is just stellar.
So really, great job, James. I know you've spent a lot of time on this, and as has Jim Siktakis. So great job there. We talked a little bit about Eaton, but maybe you can give a little bit of color on just sort of the various components of the business.
Yeah, absolutely. So as we kind of sought to build out industrials exposure, one area we've gone to is just the general diversified industrials company, and Eaton kind of typifies that. They really do it all. It's tough to point to one product they make that really moves the needle, since they make everything from aerospace components to advanced electrical components to golf club grips, is another product they make. But to take a step back.
Yeah, James,
Sorry.
I just wanted to before you jump on, one of the things that really caught my attention was their power management systems in a world of advanced manufacturing and automation. Pretty important to have, clean supply of power. And this to me seems like one that makes a lot of sense in a world where we're reshoring manufacturing to the US.
Absolutely. And we're always looking for these types of companies that are going through big transitions like this. And this has taken place over a long period of time at Eaton, but they've gone from a traditional machinery manufacturer to a proper diversified industrial. Now they're leaning more heavily into these electrical components, and they're ascribed a higher multiple based on that. It makes sense. So they've broadened product offerings. They're selling into EV production and advanced power management. As you say, it's become a big part of the business. And it's done wonders for the stock.
Look at the way it pulled back this morning off the open and traded right back into the top end of the range. I really was impressed by the trading there today. Around the same time, we bought Crane, and I don't think a lot of people are familiar with Crane. This was more sort of for growthy portfolios. Maybe you could talk a little bit about this and why we bought it. It's a spin out that not a lot of people had followed.
That's right. And it is an old company, but the way the company trades as ticker CR now is different than it was at any point in history. So we actually added to the portfolios Eaton and Crane on the same day. And Eaton made more sense as about $100 billion market cap company versus Crane at 7. For some of the bigger products, the lower volatility products like the income and balance products, we added Eaton, and some of the growthier portfolios, we added Crane. So it's small. I had met with management the day before we added the company, and was really, really impressed. It's one of the most focused and clean stories that I've seen in public markets ever. So Crane manufactures pumps and valves for specialty applications. That's all they want to do. It's all they ever want to do is just pumps and valves. So they do plain hydraulic pumps and they do specialty pumps for chemical and pharma applications as well. So tied into the industrial economy, it does have a domestic US focus, another beneficiary of the reshoring trade in diversified industrials. The business they spun out was non-core. It spun out last spring. They had a payments business. So they've really cleaned up the story. It now trades as just the pump and valve manufacturer. Their growth strategy is inorganic. So they're looking to buy other pump and valve manufacturers. And from what I understand, it's a pretty fragmented industry. There's a lot of mom and pop specialty pump and valve manufacturers. So Crane, they're targeting 9-figure deals. They've done 2 of them so far since they've been trading as ticker CR in the way they are now. And they're looking for more. If management can't find suitable acquisition targets, they're going to lever the company to hit their net debt target, which is about 2.5 times EBITDA. And they're going to give all the money back to shareholders. So they'll raise the dividend and they'll buy back a bunch of shares if they're not able to find suitable acquisitions. So provides a bit of a bid under the name. We like it a lot. And the ultimate goal is to grow the business more, make some of these acquisitions and kind of shore up the holes in the industry. And then they want to sell themselves to a bigger diversified industrial company, someone like a Honeywell
We
who's looking to
we
acquire.
we always love to see businesses get spun out of big existing companies because in many cases, shareholders have no idea what they're getting. They just decide to punt it and get rid of it. Most often, by the time they're spinning out a unit, it's been set up for success. They finance it well. They put it in a good spot to be successful. And generally, it unearths a bunch of value. So certainly that's been great. And James, I want to ask you just to talk about one other company. This is one we haven't spent a lot of time on, but
Yeah.
it's one that has been a real performer, and that's Axon Enterprise. Um, um, what does that tell people exactly what these guys do? It's not the
Yeah.
most popular business, but
No, but I think it should be. I mean, I'm always happy to talk about Axon. Their business, they sell police body cameras and they sell tasers. The way that they would phrase it is they sell a less lethal option for police departments, which, I think there's an argument to be made it's a societal good. But that's their business. They sell body cameras, tasers, and then they sell a software overlay for management of the body camera footage. They are going through a product cycle right now. So if you think about the traditional taser, as I'm sure many viewers are thinking about it, it's the 2-prong shot. It'll go about 10 feet. A police officer has about two rounds in the taser. That's changing now. So that product is called Taser 7. They've released Taser 10 around this time last year. So it shoots one projectile. It goes up to 40 feet, so substantially longer distance. You have 10 shots with it, and it's a really compelling product for police departments globally. So they're doing a lot of business upgrading police departments to the new product in the US, and it's opened up international markets, like in the UK, where there's less of a desire for police to carry firearms. Now they don't have to. They can just carry this taser product. The taser products are also priced on a subscription basis, which is great. So it's recurring revenue that Axon's doing in this product upgrade cycle. And we owned the name this time last year. We eventually got stopped out of the name because what had happened with prior taser cycles as well is that as Axon builds production capacity, they see some margin compression. And that was a bit of an overhang on the name last year. But we're now through 2 consecutive quarters of expanding margins. Margins are actually higher than they were pre-Taser 10 release. When you talk to police departments, they're excited about this product. Everybody wants it right now. And at least in the US, police departments are cashed up. They're coming off of years of high municipal tax receipts. And so police budgets are high. This is a great product for them. They're looking to add more of it, and it makes a lot of sense.
so James, good job on all these, and
Thank you.
certainly just I'm glad you're able to share some of this stuff. So we're going to move quickly. Materials continues to be a space that we think has good opportunity. You can see over the last few weeks, we after breaking out have pulled back. So we'll spend more time talking about this along the way. Uranium has been a a big driver for us. This is the URA ETF. You can see pulled back over the last couple of weeks. This is Cameco. This would be our big single position. We own Next Gen Energy and the small caps, and we also own the uranium participation units, which ultimately owns and holds physical uranium. The metal and miners, came out of the consolidation at the end of November, pulled back into the short-term moving averages. You can see here, we'll see where we go from here. This is up to today. The steel group looks similar. I think really these companies are consolidating ahead of, what we see by way of rate cuts. As the Fed eases, this economically sensitive group should be strong, and I think it's a relatively under-owned group. Energy is similar. Energy, came out of a terrible bear market. In fact, the Canadian energy sector went down 83.4% from top to bottom from 2015 through 2020. The XOP, which is the US energy producers ETF, went down 90% over the same period. Certainly it's been consolidating, but I want people to think of it this way. From the time the bear market began in stocks in December of 2021 to today, the Canadian capped energy index is up 44%. So certainly it performed very strongly for a number of months when the market started to weaken. We certainly have consolidated for a while. There's some really strong cash flow generators here and strong dividend payers. This is a group that we're comfortable waiting on. Pharmaceuticals, something that we've talked a little bit about. We've been highlighting Lilly, which of course blew the doors off the earnings last week, continues to be very strong, was up today. In the consumer, we focused in a couple of category killers. Amazon, which reported great earnings last week. Costco, which has been a very strong performer, made a 5-year high recently. You can see relative strength, just continuing to firm up versus the rest of the market. And some of the mass market stuff, Dollarama and Couche-Tard, have been good companies to own here. Areas that we continue to avoid, utilities. This picture tells 1,000 stories. This is relative strength versus the rest of the market. Just continues to underperform. For folks that have been looking for something that is defensive because they're concerned about a recession, they are getting nothing out of this. Nothing out of the REITs, relative strength, new lows this week. A lot like the bonds, relative strength, new lows for the bonds. So these companies are high dividend payers. They tend to have very little growth, very little economic sensitivity. They don't tend to do well once rates start going higher. The TLT ETF in price is down 44.5% over the last 200 weeks. That's a really long time to be losing money. If I were a bond investor, I certainly would not be a happy person. So some key things that we continue to focus on. Since the bottom in rates, transports, economically sensitive versus utilities, defensive, transports outperforming, and as of this week, making new relative highs versus utilities. Financials versus REITs. In other words, lenders versus borrowers. In a rising interest rate world, it belongs to the lender, not the borrower. And we want to stick with this theme. It continues to work since the bottom in the rate cycle. And I put this up on Twitter yesterday for those concerned about people wanting to take risk off the table. This is the high beta or higher risk part of the market, more economically sensitive, versus low volatility defensives, higher beta continuing to make higher highs and higher lows. So we think that the health of the market is pretty good. We can correct at any time. We're going to get a couple of 5% corrections a year, and you don't know exactly when they're going to come. Maybe we'll get one now, but the market internals look strong. The key themes that are working continue to work. The groups that have not been working that you would expect to do well if we were going to have some significant correction are really showing no relative strength. So this is where we come down. Financials continue to be our biggest weight. We think that the risk reward there is good, and financials tend to do well in higher rates. Technology is a smaller than market weight, but you can see the package of technology companies we own has been significantly outperforming the group. Industrials is a group that we actually added to over the last month, but has been an overweight position. Energy came down a little over the month. Materials came down a little over the month. They're consolidating. We'll see if they get going. You got to use your stops. Consumer staples is an underweight. Healthcare is an underweight. Consumer discretionary is a significant underweight, as is communication services, real estate, and utilities. Bonds are a very small part now of the portfolio. We own some corporate bonds in our balanced mandate, but this is still a portfolio that is aimed at a reflating world. Last few points. We mentioned flows generally are strong in January, February, March, and April. Wanted to highlight this. Private equity funds have record dry powder. So certainly they're looking for opportunities to take companies private. We know that equity mutual funds have higher than average cash positions, and households have a significant rising cash position that can certainly work its way into the market. And equity flows have been out of the market over the last 2 years. Certainly we know the market has been rallying. So things that we're watching from a risk perspective: credit spreads continue to narrow, or the excess return that bond investors demand to take the risk to buy a corporate bond are narrowing. That means they are comfortable with risk or credit risk. Volatility remains in a relatively low range that tends to be associated with bull market conditions. So look, we've just exited a cyclical bear market. There's a lot of people stranded on the sidelines. We think that pullbacks will be met by buyers, and we'll watch for change. If our indicators get really negative, we'll get defensive. If our individual positions stop working, we'll stop our way out. But as it is right now, we think the markets are generally constructive. And we know that in election years where there's an incumbent up for re-election, since 1950, 100% of the cases were higher, an average of 12 to 13%. So Pamela, I know we've run over, it's 45 minutes. If there's questions, I'm happy to answer.
Thanks so much, Dave. Yeah, we have a lot of questions today, so I'll try and narrow them down here. First things first, question on Fairfax. Recently there was a short sell report for Fairfax Financial Holdings. This was a position for Barometer late last week. I don't know if you could comment on that trimming, what do we do, and where do you think the stock goes from here?
Yeah, sure, absolutely. And I meant to mention it. So as some people may know, there was a short report that came out from a company called Muddy Waters. They are a company that tends to build a short position in a company and then release a report talking about why it is they think that it's something that should be shorted. Fairfax has been on a tremendous run, and the stock sold off 11% the day that report came out. It did not break trend. The company came out, of course, and said, look, so the major concern that the short seller had was that they were questioning the values that they were putting on the private holdings that they have. So I'm sharing here the chart of Fairfax. These are monthly bars. You can see it pulled back to the bottom end of the month before, and since then has rallied. So let's look at it on a weekly basis, where it dropped to about $1,207. It's at $1,325. They report their earnings on Thursday of this week. You should expect them to respond. They're in their quiet period. They cannot respond until they report their earnings, but they did say that they would have a press conference on Friday to answer any questions. So definitely an initial negative response. Didn't break trend, so we don't get stopped out. But we will use our stops. And I won't tell you where the stop is, because we generally keep that to ourselves. But we expect that the company will clarify the situation. And at this point, we think that the market response has been relatively muted.
Thanks so much, Dave. Here's another question from Rajiv. He says, Dave, great update as always. Love seeing James Callahan on the program tonight. Always enjoy your reviews. Could you touch a little bit on SHOP, especially after the run up into earnings, today's price action, and future? Thank you so much.
Yeah. So SHOP did have a weak day today. I'll just throw it up on the screen if I can. Sure. Stock kind of got up and above the rising 200-week moving average, and then pulled back to close lower on the day. So it's above our stop level currently. We'll see where it closes on the week. I'd prefer not to see it close below the low from last week. We'll see whether it gets any recovery or not. But if it breaks the lows, we'll take it out. This has been a really nice bounce since it made the low at $25. It's basically tripled, and it's not it's not a low volatility company. So we'll watch it. It's not a big position for us, but certainly worth watching. We'll see how it closes out the week.
Thanks so much, Dave. A question here from Lawrence. He wants to know, do you think it's time to add more Canadian banks to your portfolios?
It's a great question. You've seen some pullback, for instance, in TD. I think that's one that we are of any of the Canadian banks probably the most concerned about. Scotia's been a relative underperformer as well. We don't add on strength, on weakness. We add on strength. The ads that we've been making in financials have largely been insurance companies. Manulife, Sun Life look good in Canada, Intact in the property and casualty space. We've talked before about Progressive, which has been just a dynamite, steady performer. Reinsurance Group, RGA, is a holding. At this point, we aren't adding more Canadian banks. We prefer things like Citi and JP Morgan, given their profile currently.
Thanks, David. And let's end the program this evening with the last question from Sebastian. He wants to know your thoughts on cryptocurrency, Dave.
Well, I've alluded to it over the last few weeks, and I don't push too hard on it because it's a controversial thing. We have about an 11% weight in our macro portfolio. GBTC is the grayscale Bitcoin ETF. I put up on Twitter last week GBTC versus the equally weighted S&P. I think that's pretty bullish. So if we make it a longer term picture, let's just look at Bitcoin in general versus the, let's see, BT USD versus RSP. That's not what I'm looking for. Sorry. So that. Okay. So there's Bitcoin in US dollars. This is the bear market that went on from November of 2013 through February 2017. And as you came out, you had a very significant run. When you had the bear market that went on from 2017 through 2020, came out, you had a pretty significant run. And when we look at where things are today, it certainly, to me, it looks like it's recovering on a relative basis. There's Bitcoin versus the equally weighted S&P. you know, we've made an exit from a period where equal weight S&P was outperforming. So you know, we have a weight there. I think that given the fact that, you know, you have spot ETFs that are now in the market, they are consuming a lot of Bitcoin. I saw numbers something like 12 times as much Bitcoin is being produced. So a lot of Bitcoin is getting into the hands of investors who are relatively new. And I think institutions are stepping in as well. So from a macro perspective, I think it has a place. But there's a lot of strong views. But technically, to me, it looks pretty darn good.
Thanks so much, David.
Ether looks the same. Ether versus the S&P, you know, certainly is showing some monthly strength. So we'll see.
Thanks so much, Dave. And thanks, James, for joining us. Dave, I'll leave you, as always, with the final word and see you all here next week, same time, same place.
Great. So, you know, we always care when we see a down day. What will matter more is how the market handles it over the next few days. When markets are ramping, and there's been some frothy behavior in some big stocks. Certainly, you know, you can get a bit of a shakeout. But I do think that there is money under the surface needing to come in. I do like the fact that when you get some sloppiness and the underlying breadth indicators are positive, generally the market is there and ready to absorb it. Obviously, some people concerned that the Fed may not cut as quickly given the input to CPI that the services sector gave. We'll watch that as we go forward. So we'll be back again next Tuesday. We'll take a look at what's happened over the week. And if there is any change, you know, I'm certain that we will talk about it. So thanks very much, Pamela. Thanks everybody for joining in. We appreciate your interest. Have a great week.